VTSAX and chill. It's what all the kids are doing these days now that Netflix has cracked down on password sharing. But don't worry, parents. It's not a euphemism for anything. It's just one of the most discussed and commonly recommended pieces of financial advice targeted towards younger investors. That the only index fund you'll ever need is a total stock market index fund, like VTSAX from Vanguard.
That this could literally be the only investment that you make from here on out.
Or its sibling ETF, VTI. Now you all know I love me some index funds, and I largely believe that trying to beat the market by picking stocks is a waste of time. But I got to thinking, which is usually a pretty dangerous activity, surely it can't be that easy, right? Just one fund, set it and forget it? What if we're all missing something? What if there was a way to beat the market by investing in index funds? This could be the missing link, the one thing that brings balance to the investing world. Stock pickers and index fund investors living in peace and harmony. No, there can't be. Surely we would have heard about it by now. Who would want to keep such a discovery from us? But I wasn't deterred. There must be a way. I will bring peace to the investing community once and for all. So I started doing some research. What are some of the most common complaints about index funds like the total stock market index or the S&P 500 index? And the one main thing I found that detractors point to when criticizing funds like VTSAX or the S&P 500 index, it's that their holdings are too overweighted towards large cap growth stocks. The Apples, Amazons, Microsofts, and Googles of the world. And I gotta admit, it's a valid complaint, because while the S&P 500 index holds 500 different companies, and the total stock market index like VTI holds over 3,000, they don't hold equal amounts of all those stocks that make up the index. Instead, they're weighted by market cap, which means the larger companies make up a larger percentage of the index. And you can see this play out when we look at the holdings. Over 13% of the total stock market index is comprised of those 4 companies I just mentioned a second ago. And that's over 16% when looking at the S&P 500 index. So yeah, just those 4 companies make up a very large percentage of both index funds. And while they're all extremely high quality companies that most of us would probably have no problem at all holding, they're also already huge, meaning most of their explosive growth has already happened, and their quote unquote best days of providing returns are probably already behind them. Let's face it, the likelihood of a company the size of an Apple or an Amazon doubling again is pretty unlikely. At a certain point, being so huge just starts to work against you in that regard. So the argument that the critics of this strategy have is that when you're investing in these funds that have a heavy tilt towards US large cap growth stocks is sure, you'll get good returns, but you're not going to get the best returns. So, okay, challenge accepted. If we want to beat the returns of VTSAX, the total stock market index fund, whose holdings are very heavily slanted towards large cap stocks, we're going to have to add some sort of diversification to our portfolio. Some other asset class is going to have to help us beat the total stock market index. But what's going to work best? What exactly should we diversify with to meet that goal? And to find out, I did an experiment. I decided to look at some popular index fund asset classes and create a bunch of test portfolios out of them to see what kind of results they would produce and to see if any of them would beat the total stock market index fund. I looked at, in my opinion, what are some of the most popular indexes that people invest in. Of course, the US total stock market index, represented by VTSAX and VTI, a US large cap growth index, which would be something like the S&P 500 index fund, a US small cap value index, a global ex-US index fund, something like VXUS that invests in the total stock market from around the world, excluding the United States, an emerging markets index fund, which will invest in up-and-coming economies from around the world, and the total US bond market, which we commonly invest in through something like the ETF BND. So I took all of those indexes, and then I created some sample index fund portfolios out of them. The first portfolio is going to be our control portfolio, the total stock market, 100% in VTSAX. The VTSAX and chill strategy we're going to try to outperform. The next portfolio I came up with is another 100% stock portfolio. This one is investing 80% in the total US stock market and 20% in the total global stock market. So it'd be something like an 80-20 split between VTI and VXUS. So we'll see if just adding in some global stocks will boost our returns over just holding the total US market. The third portfolio I created is the tried and true conservative 60-40 portfolio. We'll call this our boomer portfolio. This is going to be 60% in US large cap growth, S&P 500, and 40% in the total US bond market. Because maybe in those years where the US stocks are down, that bond allocation boosts up the portfolio and provides better overall returns over our experiment. The next test portfolio I'm going to call the barbell portfolio. This one is going to be 50% in US large cap growth, so 50% S&P 500, and then 50% in US small cap value. So this portfolio, we're taking the US stock market and we're heavily weighting ourselves on both the large and small ends of it. Then our next portfolio is just going to be the total diversification portfolio. We're going with 35% large cap growth stocks, 25% in the small cap value, 15% in the total global stock market index, 15% in those emerging market up and coming economies, and then sprinkle in 10% for little bonds. This portfolio really has a little of everything. And finally, the last portfolio we're going to test out is 100% US small cap value stocks. Because we're working on the thesis that the problem with investing in the total stock market index or the S&P 500 is you're too heavily weighted towards those large cap stocks. So in this one, we're going to go extreme in the other direction. We're going to YOLO on the little guys and see if they can help us beat the total market. And then to test all these portfolios out, I went to the Portfolio Visualizer website, which is a fantastic free tool for analyzing and backtesting different portfolio constructions. I tested all of these portfolios against each other over the past 10, 20, and 30-year time periods. And the results may not be what you expect at all. So first off, we have our control portfolio. VTSAX and chill, 100% in the total US stock market index fund. Now, a few important notes on how I ran these tests. I ran these all with no rebalancing of the portfolios and no dollar cost averaging into them over the time periods. I ran this as a true set it and forget it. You invested the money in your portfolio and then lost the password to your account for the duration of the test. I also used the year end of 2022 as our cutoff. That just seemed cleaner as it's the last full year of data we have. As I'm recording this, we don't have all of 2023's returns in. So now to the results. Our control portfolio, 100% of the total US stock market index fund, returned a compound annual growth rate of 12.34% over the last 10 years. If we expand that out to the last 20 years, it becomes 8.17% and 9.44% compound annual growth rate over the last 30 years. So that's our benchmark. That is our bar to clear. Let's see if any of the other portfolios can do it. And we'll start with the 10-year test. Our Own the World portfolio, that was 80% total US stock market, 20% global stock market, had a compound annual growth rate of 11.24% over the last 10 years. Our Boomer 60-40 portfolio returned 9.42% for the last 10-year period. The Barbell portfolio, split between the S&P 500 and the small cap value, returned 11.84% over the last 10 years. That jumbled up, totally diversified portfolio, a little bit of everything, that returned 9.32% over the last 10 years. And our YOLO portfolio on 100% small cap value stocks returned 10.89% over the last 10 years. So now let's zoom out just a little bit and look at 20-year returns. 80-20 US international portfolio returned 7.73% over that 20-year period. Our Boomer 60-40 portfolio between stock and bonds returned 6.47%. The Barbell portfolio returned 8.25% over 20 years. The total diversification portfolio returned 7.43%, and the YOLO small cap value stock portfolio returned 8.59% over 20 years. Now let's zoom out a little bit more and look at 30 years. The 80-20 split between US and global portfolio returned 8.87% over that 30-year period. The 60-40 Boomer portfolio returned 8.18%. The Barbell portfolio returned 10.37% over 30 years. The ultra diversified portfolio would have returned us 8.77% over the last 30 years. And the 100% small cap value index fund portfolio returned 10.61% over the last 30 years. So you notice anything about those results? The two portfolios that are heavily invested in US Small Cap Value Index beat the total stock market fund over both the 20 and 30-year time periods. And if you're wondering, those portfolios also won over 25 years and 40 years. I checked. So what does that mean? It means I did it! I have solved investing! The secret to an index fund portfolio that beats the market is to diversify with small cap value stocks. And it makes sense, right? The total stock market index and the S&P 500 index are so heavy on the large and mega cap stocks that the obvious way to outperform them is to simply move towards the other end of the spectrum. But let's hold up right there. Before I get too far into my acceptance speech for the Investor of the Year award, that exists, right? We have to look right next to the flashing neon sign that should be right here that says this YouTube video is not financial advice, and look at a little thing called reality. Because it's not so simple as to just say, okay, 50% S&P 500, 50% small cap value, or even 100% small cap value is the absolute ideal portfolio that's gonna trounce the market. Because after doing this initial test and seeing those results, I went back and tested our two winning portfolios against the total market over various other 20 and 30-year time periods with different starting and ending years, as well as different 5, 10, and 15-year periods with different start and end dates. And as I did that, a trend started to emerge. I found that over just about all of the 20, 25, 30, and 40-year time periods I looked at, the portfolios more weighted to US small cap value did seem to outperform the total stock market index, but never by a really large margin. And over the 5, 10, and 15-year periods I looked at, those portfolios weighted towards the small cap value always seemed to underperform the total stock market index. So in order for this to work out in your favor, you would have to choose that allocation and really hold on for the long term, which is more easily said than done, because that small cap value index is also wildly more volatile than the total stock market index. When it falls hard, so you need to resist all temptation to make changes to your portfolio as you underperform for 5, 10, 15 years, just hoping that the payoff of an extra % or two in returns is there waiting for you at the end. And that's even without saying that past performance doesn't necessarily predict future outcomes. And there's no telling what asset class is going to dominate the next 20 years. Almost every one of those index funds I included in this test had a period of 5 or 10 years where it was the hot asset class. And that's why I like to reiterate, investing isn't a contest to see who can generate the best returns in the world. Investing is simply a tool to be used to help yourself reach your financial goals. And in that regard, diversification is your friend. It's much better to achieve pretty good returns with a strategy you can 100% stick with than to chase down the quote-unquote best returns with a strategy that will drive you nuts and have you questioning every life decision you've ever made with its wild swings up and down. Be sure to check out this video next. Thank you as always for watching this one. I'll see you next time. Now get out of here.